Today we're diving into a really powerful analysis report.
Mm-hmm.
It's titled Nebius Group, NBIS, The AI Infrastructure Giant Waking Up, plus 60% upside.
Right. And the core argument is pretty compelling.
Yeah, it really is. It contends that Nebius has basically secured Tier 1 status through these massive guaranteed hyperscaler contracts.
With Microsoft and Meta, yeah.
Exactly. And that despite this recent stock pullback, the current price is a distinct entry point to capture, well, a 60% upside towards that consensus target of around $160.
And that's undeniably a powerful place to start. I mean, securing over $20 billion in backlog from anchors like that?
It immediately validates everything.
It validates the infrastructure, the execution. That kind of revenue visibility is, well, it's the envy of the entire sector.
It's impressive. But the analysis builds its case for that 60% upside largely by just citing that analyst consensus target.
And, this is really the first place where I think we can strengthen the report's foundation.
Okay.
The connection between that massive revenue backlog, and the stated 60% upside target. It just needs a more robust argument.
An argument coming from its own financial details, not just...
Exactly. Not just relying solely on what analysts are saying.
Okay, let's unpack that a bit. The material already highlights these monumental deals. You have the, 17.4 to 19.4 billion Microsoft deal.
And the $3 billion from Meta. So well over $20 billion in guaranteed committed backlog through 2030.
So with numbers like that, why isn't just citing the 160-plus analyst target enough? I mean, it clearly shows the quality here.
It really comes down to conviction. It's about independence. The weakness here is that the analysis uses that consensus target to justify the return. And while the analyst might be right, if that consensus shifts for any reason,
your whole thesis just falls apart.
It collapses. The conviction of this analysis would be exponentially stronger if that target price was modeled internally. You've got the impressive data already, that $20 billion backlog.
Use the receipts you already have.
Yes, exactly. Use them to calculate your own price floor.
So the idea is that the visibility validates the quality of the company, but we shouldn't use it to validate the final price calculation itself.
That's the key. You have to ground the valuation in the specific data points that Nebius actually controls.
Right.
So the suggestion is pretty straightforward. Establish an internal, data-driven floor, or maybe a projection, that comes directly from that contract visibility.
And that validates the upside case completely independent of the analyst community.
It grounds the thesis in Nebius's specific execution, not just, general market sentiment about AI infrastructure.
Okay, that makes sense. It moves it from correlation to causation. But what about risks? If we model the floor purely off that backlog, aren't we ignoring things like early termination clauses or market shifts that analysts do factor in?
We don't ignore them, we just isolate the intrinsic value first.
Ah.
The goal is just to define a credible, minimum enterprise value that has to be there based on guaranteed revenue. It gives the reader a solid reference point that doesn't fluctuate with quarterly noise.
And then once you have that floor,
then you can layer the risks on top of it.
That makes the argument so much more resilient. Okay, so what are some concrete ways to actually do that, to implement that internal modeling?
Well, you could introduce a simple perspective based on, say, a discounted cash flow or an enterprise value derived only from that secured $20 billion backlog through 2030.
So you're just looking at the contracted revenue.
That's it. It instantly shows the intrinsic floor value of the company's assets. It's the cash machine value, plain and simple.
I like that approach. Or, alternatively, I suppose the report can move away from just citing the consensus price to sales multiple.
Yes. Instead, compare the projected PS ratio for Nebius against a peer that has similar guaranteed long-term revenue.
And you could use that reported $146 million in Q3 2025 revenue as a starting point.
A perfect starting point. You project forward with the guaranteed stream, and then you can compare that multiple against a company in a totally different sector, maybe a utility or an industrial equipment lessor.
Wait, why a non-tech peer?
Because the whole point of this thesis is that these massive long-term contracts strip away the volatility you normally see with AI infrastructure.
Okay, I see where you're going.
By comparing Nebius to a peer known for revenue stability, you validate the multiple using its unique position. You turn the narrative from AI upside into guaranteed revenue stability, and that strengthens the valuation bridge immensely.
Let's use that idea of stability as we shift focus now, because that stability is only real if Nebius actually executes on its very aggressive build-out plan.
And it is aggressive. The analysis highlights that $5 billion CAPEX guide for 2025.
Which is both the major catalyst building the data centers and the major risk.
It's the single largest and most critical moving part in this entire analysis. And that brings us to our second point.
Go on.
The analysis report needs to more tightly integrate that $5 billion CAPEX guidance with all the execution and profitability risks that come with it. It should be a coherent, time-bound challenge, not separate pieces.
So the problem is that execution risk is just what, a bullet point in a different section?
Exactly. It fails to capture the narrative tension Nebius is facing right now. They have the revenue, but they could hemorrhage cash trying to get the infrastructure ready on time. The weakness is that the financials, the hockey stick moment section, correctly highlights the CAPEX needed, but the immediate consequence, short-term losses, delays in power, or chips, is just relegated to a separate bear case list.
It feels detached.
It completely weakens the coherence of the awakening thesis. It makes this massive, necessary investment seem like an optional risk.
When really, it's the required hurdle they have to clear to turn that $20 billion backlog into actual revenue.
Precisely. So the suggestion is to frame that $5 billion in CAPEX not just as a cost or a risk, but as the critical, time-bound conversion challenge.
I like that framing.
The analysis needs to clearly explain the critical path dependencies between this investment now and the revenue spike they expect in 2026. This is where the reader needs to see the pressure points.
So we turn the risk into a measurable, time-sensitive milestone that readers can track, rather than just a generic disclaimer. How do we do that? How do we model that dependency?
Well, for improvement, you need to explicitly model the relationship. Show what portion of that $20 billion backlog relies on the timely completion of specific facilities.
For example?
For instance, if 20% of the Meta contract depends on hitting the 60,000 GPU capacity at the Finland facility by Q4 2025, you quantify that dependency.
So you link a specific CAPEX deployment to a specific future revenue stream.
It makes the risk tangible, and then you can refine the execution risk section. Instead of generic concerns like chip delays, you directly link potential delays in, say, Kansas City or New Jersey.
To specific contract milestones.
That's right. Show the actual impact on revenue visibility for Q1 or Q2 of 2026. Like a 6-month delay in power permits in New Jersey directly impacts $1.5 billion of the Microsoft contract. That's actionable.
And building on that, the report does mention that the cash for this CAPEX is largely secured by debt financing tied to the Microsoft contract.
Right, which is a key mitigating factor.
And that needs to be integrated into this execution discussion, not just left in the financials section.
Absolutely. You have to include a brief discussion on how that debt financing is linked to the collateral of the secured contract. It shows the financing mechanism is robust, and it offsets some of that logistical risk.
It shows the reader this whole build-out isn't just based on a prayer.
It's an orchestrated plan where the revenue is already collateralizing the construction.
That really strengthens the whole thesis. Okay, let's shift gears now from the massive contracts and the infrastructure build-out to the tech advantages Nebius is deploying. What I really liked about this part was the focus on the operational moat. Specifically, the early adoption of high-demand chips like the NVIDIA Blackwell B200 and the launch of these self-service clusters.
The report nails the operational aspects. It does. However, and this is our third critique.
Go on.
The analysis needs to articulate more clearly how those operational advantages, especially the self-service offering, create pricing power and mitigate customer concentration risk.
Okay, so the weakness is that the operational moat section accurately notes the self-service model, but it doesn't fully explain its strategic value.
Right, it's just noted as broadening their customer base.
Which it does, but
given the overwhelming revenue concentration in Microsoft and Meta, over $20 billion tied up in just 2 customers, that self-service strategy isn't just a secondary market. It's a critical strategic escape hatch that deserves a much deeper strategic focus.
That makes a lot of sense. The 2 big deals provide stability and volume, but they also represent enormous concentration risk.
So the self-service model has to be seen as the primary diversification mechanism.
Right.
The suggestion, then, is to clarify the unique profitability and strategic diversification provided by this on-demand GPU rental segment compared to the long-term, fixed-rate leases held by the hyperscalers.
This is the distinction that really solidifies the moat. It makes Nebius more than just a dedicated factory for 2 huge clients.
Exactly.
So we need to show that this self-service model isn't just about volume, but high-margin premium volume. How can we make that clear?
A simple structural comparison would work for improvement. You could explicitly state that the availability of H200 and B200 GPUs on demand creates a fundamentally higher margin premium revenue stream.
Compared to the lower margin volume contracts with the hyperscalers.
Of course, hyperscalers command better rates because they guarantee bulk usage for years. Developers renting capacity by the hour, they pay the scarcity premium.
So it's about optimizing their capital deployment. They use the long-term contracts to justify and finance the $5 billion in capex.
But they leverage the resulting high-demand infrastructure to extract maximum immediate profit from the mid-market with the self-service model.
That dual strategy is the key differentiator.
Absolutely. And furthermore, the analysis needs to show that these self-service clusters offer a necessary strategic reduction in customer concentration risk. This segment gives them immediate exposure to the volatile, high-growth mid-market AI sector,
Which is currently underserved by the dedicated hyperscalers. It's essential for the long-term sustainability of the giant waking up narrative.
It proves they are not purely dependent on two customers, no matter how substantial those contracts are. That's the high-level insight we need to elevate.
This has been a really detailed critique, I think, aimed at maximizing the impact of what is already a very strong analysis.
For sure, we covered a lot of ground, mainly focused on grounding the thesis more fully into Nebius's specific execution data and their strategic moves.
So we focused first on the valuation, suggesting that the internal modeling needs to be enhanced to really validate that 160-plus target.
And the key actionable step there is creating an independent floor valuation derived directly from that $20 billion backlog. Isolate the intrinsic value.
Then we address the structural flow. The idea is to tightly integrate that $5 billion CapEx challenge with the profitability timeline. Frame it as that critical conversion challenge.
Yep. And the actionable step is to model the direct financial dependencies of the CapEx build-out on those key facility milestones.
And finally, sharpening the operational moat by clarifying the strategic significance of the self-service GPU clusters.
Right, articulating their unique role in providing higher margins and, crucially, mitigating that huge customer concentration risk.